right. Hello, everyone. This is Winston Wilson with the Rising Tides Charity as well as WD Consulting. We are so thrilled that today we're going to do something that we've been wanting to do for a period of time. I've invited our managing member of the WD Consulting Group, Mr. David Wilson. What's up, Dave? How are you?
Yeah, what up? What up?
We are going to talk about stocks today, and this was an ideal that came about when we started to see that a lot of people are going out these days and getting involved in stocks, whether they're using new technology like Robinhood and other things. And Dave gave a presentation for another group that we were part of. And I was like, that is so incredible. He did such a fantastic job. And if you hear like a lot of politicians and a lot of people talk about wealth and how wealth is built these days, they talk a lot about stocks. And a lot of people in the community, in any community, however you define community, don't have access to that. Or they don't know how to start, or they don't know what it means, or they don't know how to figure this whole thing out. So I was like, this would be a great topic for us, especially as we start to continue to launch our consulting arm of what we do, to talk about how can people get involved. Because it's one way to create wealth. It's not the only way, but it's one way to do that. So I thought we would do that today and we'll kind of walk through this. So we're going to walk through a presentation. And so for those of you who are joining us or listening to us live, we'll obviously respond to that. But if you're listening to this afterwards and you have comments about what we've talked about today, feel free to subscribe and link to what we're doing on the Rising Tides Charity as well as WD Consulting's YouTube page so we can help you out. At the end, you'll see a link in regards to a way you can get involved. If you have questions, if you want to talk to us more directly, you'll see a link that you can paste into your browser and to hit us up directly, and we will have a consultation with you for free. So, with that being said, Dave, thanks for joining us. I really appreciate you so much. Let's get going if you're ready to get into it.
Okay, yeah. And I just wanted to add to what you said. As we do see that people are more interested into investing, one of the questions that a lot of folks have, and sometimes they're not willing to actually say that they have that question, is what are they actually investing in when they talk about investing into a stock, right? Everyone wants to do it. Everyone sees, from when you were a child, you heard other people talk about it, whether if you were invested, if your family was investing, or it was just something that was mentioned in TV, right? When you listen to Donald Trump talk about the stock market rising and and that things are going great, what does that really mean? So today, of course, in 1 hour, we can't cover every single thing about stocks, but this is kind of like at the bottom level of groundswell to try and give you an idea about what stock really is.
Right.
So if you've ever had that question, if you've ever wondered, this is where we're going to explore it, right?
Yeah.
Both me and Winston, we spent years in business. We both have MBAs, but those MBAs don't necessarily relate into you just having some of this general knowledge. That's not the reason why we just have this, right? I'm an educator, and I hope that you find this to be helpful.
That's fantastic. I think you make a great key point here is that once you know about stocks, then you got to go get some, right?
Yep.
And you got to figure out what's the right way to do it. And you and I, we talk with lots of good friends a lot of times about what to invest in and how to do it because the market, which you'll find in part two and part three of these conversations, is that the market moves a lot. And there's a lot to learn even beyond this primer in this first conversation. So thank you for that kickoff on that. So we're going to go back and forth between the presentation here and just kind of dialogue. And at some points, David, I'll probably stop you and say, hey, let's talk a little bit more about this area or that area. So with that being said, we're going to go ahead and kick us over into the kickoff here. So your first slide here just really talks about what is stocks 101, and I think you gave a great foundation on that. I don't know if you wanted to add anything to just the foundation of it, but I thought that was a great kickoff.
Yeah, so we can just move. This, like what I said, this is ground level. Nothing earth shattering. If you're a heavy investor and you think that you understand what stocks in, you can still listen. You might find an interesting perspective for when you're speaking to other people that need to be in the know, right? So this is a little bit of a knowledge share, if anything.
That's fantastic. So we're going to move on to the next slide here.
Okay. So when we look at company structure, right? We're going to talk about there are two ways for a stock, for a company itself to exist, for it to raise funds and for it to manage itself, right? So one is equity, right? So equity is considered to be stock, right? You actually have ownership stake, right? And this happens whether or not if a company is a sole proprietor or if they are, Fortune 500 company, right? And then the other side of it is that you have debts, bonds, loans, long-term, short-term debt, right? So the whole stake of it says that if I have debt, if I owe money, I take out a loan so that I can buy a storefront, so that I can buy equipment for my storefront. The equipment that I buy for my storefront, that's actually going to be considered an asset, right? It doesn't really contribute to the actual equity, and we'll get into this, right? Equity is going to be what you've actually come out of your pocket to invest in the company, and then also whatever kind of assets are accumulated strictly by the company itself, right? So we'll go further into it so that there'll be greater clarity as far as this. But the company structure is that either you're going to have equity and you're going to have debt, right? And those are the two lines that really sit in there. And on the other side of equity and debt, you have assets, and the assets will add up to that equity and debt, right?
Yeah, thank you. Yeah, I think that's fantastic. Uh, isn't there a piece of it when you think about that structure around how much cash, especially with a mature company, that they've got on hand and how they are using that cash? I think sometimes that's something that's talked about, or sometimes it's not talked about that much. But I know when you listen to lots of earnings from different companies, there's a lot of publicity about how much cash does someone have on hand? How much does Apple have in cash
So
right now?
so so the cash structure, cash actually contributes to this, right? But cash is more or less looked at as an asset, right? And it would fall under the line of equity stake, right? So if a company is holding a lot of cash, that means that they have more assets that they can use in order to grow their company without having to go to the debt market and saying like, okay, I'm going to borrow money, right? They also won't need to go and raise funds through creating new equity, right? So that's saying that the company itself, they're viable a lot of times if they have cash, but depending on industry, depending on what the company does, um, the company will need to pay attention to how much cash it has, right? So if I operate in certain industries, me having cash may make me not as efficient as I should be, right? And certain company structures are going to say having a lot of debt on your books is going to be important, right? So if you're looking to open up a company or if you're looking to invest in a company, it's always good to know what the rest of the industry is doing, right? And it's not so much that you follow along with what the industry is doing just because they're doing it, because maybe the industry is wrong, but for you to know what they're doing and know how you're moving within that, right?
Isn't it philosophically sometimes that when you see companies that get at least initial amount of debt in their structure, that they're investing that debt in something. They're investing it in growth or some kind of plan, long-term plan that makes the market go well. They're using their debt appropriately to actually grow and to invest, whether it's in R&D or in plants or products or whatever it is.
Yeah, 100%. So, and there's also the side that would say if you're sitting on a boatload of cash, that the company isn't using that cash efficiently, and that the cash is just sitting there doing nothing, right? You should be doing all of those things that you just said. You should be buying, investing in research and development, looking to make an acquisition, looking to do something with that cash rather than just letting it sit there, right? And one of the things when I used to do financial education is that I always told people to manage your own personal finances like it was a company. And when I say manage your own, personal finances like a company, when you look at your cash that's on hand, that's one of those things that you want to do, right? So if you're holding a whole bunch of credit card debt and high interest debt, but you have a boatload of cash, sitting in the dresser, you may be better off paying off some of that high interest debt that you have with that cash, right?
Yeah. I really appreciate the fact that you brought in the personal aspect to it because that is a key way that anyone that's out there can relate. I think most people at some point do need to get some kind of debt for something, whether it's student loans or something along that line. It's just really how you manage it, and how do you maximize it. Because if you do it the right way, you can get stuff done as well, and you can make sure you don't impede your own personal credit. Um,
Yep.
so I'm going to move on to the next slide here, if you're okay with that.
Okay, so here we say, where do we commonly see this structure, right? The structure of equity and debt, right? So most people are familiar with, a house, right? And we know that when you go to buy a house, normally in most instances, they want you to do a down payment, right? That down payment that you do on that house is immediately contributing towards you having an equity stake within the house, right? The mortgage that you take on, that is your debt, right? You have this loan that's for 15 years, 30 years. As you make your mortgage payment every month, you're going to pay a portion of that towards the principal, which is going towards your equity. And then you're going to pay a portion of that, which is going strictly to interest, right? That hurts, right? Because you're paying a whole bunch of money that just goes to interest in the bank that decided to finance you being able to purchase this house. So once again, if you had the cash, cash is king. You buy a house with cash, you don't pay interest. Um, and then we see car purchases, right? You go and you buy a car. A lot of people finance their cars when they do buy them. The portion that you give as a down payment, the portion that you are paying monthly when you own the car outrightly, that asset still holds value, right? So I know that there are the people, the Kawasaki's that are out there, and all these other folks that will tell you to have this other way of looking at it, to say that the car itself is just a debt no matter what. Listen, this is finance, and finance is just going to say that if you own something that has value, it's considered to be an asset, right? And you can contribute, you can gain equity within that asset. Similar to cell phones nowadays, if you go and buy a cell phone, a lot of times you buy a cell phone on a plan. They want you to pay monthly. There's some trickery in that, right? Part of the reason why cell phone companies want to do that is because this is going to be able to give them a regular stream of income that continuously comes in, and you're going to be more apt to upgrade to the next version. And then also, when they got rid of all the subsidies that they used to provide, this was a way for them to say, like, oh, look, it's really not that expensive for you to buy this, $2,000 phone, this $2,000 phone. And then the final portion of that is companies, right?
I remember the subsidies. Yeah, I remember those quite well.
Yeah. So, cell phones first came out. The best cell phone that was available, you could get for a penny if I just signed this 2-year contract, which is great. I'm always going to upgrade. I'll stay with AT&T for the rest of my life, right? But now I have to like search around to find a deal and switch companies if I really want to be aggressive with that. But then the final part is going to be companies, right? So you're going to look in you and say companies are actually using that same structure, right? It just gets a little bit more involved. They do things that are a little more advanced than what the regular person would do when they're just going to buy a house, because the company's going to buy a house, they're going to buy equipment, they're going to pay employees, they're going to have all of these other things that they have to do that you as a regular household you may not need to do.
Right. That is awesome. So let's keep going.
So when we look at its common associations, right? So how is this equity really accumulated? One of the things that I said was a down payment, right? So a down payment is normally considered to be that initial investment. If I'm opening up a company, and I want to open up a cupcake shop, and I decide that I'm going to open up this cupcake shop, and I'm going to have to, get a website developed because I need to have a web presence, and I put 20,000 towards that, and I need to buy some equipment so that I can start making my cupcakes, and then I got to buy this whole batch of batter and stuff. So that all of these are expenses that if I'm coming straight out of, that I'm coming straight out of my pocket in order to pay, I'm making an investment into the future earnings that we're going to make in this company, right? So this is my initial investment. And this initial investment gives me an equity stake within this company, right? So if someone else was to come later, and we'll get into those other things, if someone else was to come later and we wanted to talk about how can we distribute the amount of the company. If you ever watch Shark Tank and you see that, the sharks on Shark Tank, they always want an equity stake.
That's
They
right.
want an equity stake because they're saying like, okay, we want a piece of the pie, right? We want to know what's going on, and we want to be able to own some of that actual value,
Yeah,
right?
don't you
Um,
agree on those things when someone comes in and they might have a good idea, but then when they ask them who's got a stake, and the person will say, "Well, it's 10 guys or 10 people involved with the stake," and
yep,
sometimes good ideas don't make it because it's so fractured at that point.
yep. So, this is where we get into, the other ways that equity is accumulated, right? So purchase of assets, right? So I said you may go out and you may say like, okay, you have to go and buy some. You may have to go and buy that new oven, right? So when you buy that new oven, that is considered a way for equity to be accumulated, right? Or you may not have the money to buy that new oven, so you may get it gifted to you from someone that wants an equity stake, right? Software that's purchased for you to be able to do things that you need to do. So software can, has a relation to that website, but maybe for your cupcake company, you're going to say that you need to have, some type of accounting software. You need to be able to manage what's going in and what's coming out, right? So you want to be able to track, your workflow, right? Services, right? You may need someone to come in and write a business plan from you. For you. You may need to, get someone to be, a legal person that you could turn to get advice from. When you're going to these people, you may not have cash, right? If you don't have cash, what you do have is a company that you're creating or that you've already created that you have that initial investment in, and that you can offer some equity to, right? When they have that equity in your company, then they can do something, right? Skills that add value to your trade, right? This could be a baker that you hire. You want to open up a cupcake shop, but you don't know how to make cupcakes, right? Maybe you need to find somebody that knows how to make cupcakes that you can partner with, that really knows the trade, right? Or maybe you do know how to make them, but you don't know how to make them great. You want someone that's really efficient and you don't have the money, right? So if you have cash on hand, a lot of times maybe you don't have to give up equity, but you can, right? And then the final one, which is very important, is going to be that intellectual property, right? So you're making cupcakes. Why do I buy cupcakes from you and I don't buy cupcakes from Hostess, right? What makes you special and makes your cupcakes, the thing to go to, right? So it's not just that intellectual property is always me getting a copyright and me getting a patent. Sometimes intellectual property is going to be just your special sauce, right? What is it that your company does? What are those trade secrets? What are those things that you're able to do that you can say, I keep over here and I'm never going to tell anyone about it, because if I do, they can probably replicate this and do it themselves.
The thing I love about what you've been sharing with the audience here so far is it's not only about just the companies or about just how the structure looks like, but it's really giving everyone a sense as to when you think about their own business, because quite frankly, everybody in the United States should have their own business. They
Yep.
should, of some kind. And so, how do you start that? How do you structure it? A lot of the things you shared, techno- technology has had an impact on some of those things. So whether it's software or technology or skills, there are ways to learn things faster than it's ever been.
Yep.
And there's other ways to get technology quickly. Like this call we're having now would probably be very challenging to have in 2010, for example.
We're not having it.
It's just been very tough. The technology that was necessary to do all of this stuff was in the
Yeah.
very beginning stages back then. So,
Yeah.
yeah.
I could have came down to Atlanta and we could be sitting in the same room, possibly with a big camera.
That's right. You know, the color, the lighting, the sound, all of that would have
Yeah.
been really, really weird.
Yeah. Yeah.
That's great. Um, so when you move on here, so when you think about the next piece, let's walk through this.
So when we really think about that equity or that stock, right? What is it? What does it really contribute to, right? It contributes to us being able to value, what this company is actually worth, right? So I'm going to look at it and I'm going to say, okay, look, I've accumulated my I've accumulated my oven. I've got a great baker. I've got the software. We're pumping out 100 cupcakes a day, and we're selling 80 of those cupcakes. So I know what kind of income I'm actually bringing in, and what that's really going to tell me is how can I actually value my company, right? So if I have assets, right, and I've built up this equity, right, and I'm able to say that there's this equity that exists within the company, and that we have assets, and that we're actually making money. Now I'm talking about valuing my company outside of the frame of just me just throwing a throwing a penny in the ocean and saying like, okay, this is how much we're worth. I'm able to sit there and say like, okay, if we're bringing in $100 a week, $100 over a week for a year is going to contribute to the $3,650, whatever. I don't know. I'm not going to do the math in my mind because I'm going to go off, but you're going to be able to say this is the number where we sit. Now, when you do that valuation and you're able to sit there and say like this is where we sit, this is how much we are really worth. This is where when you start saying I'm going to distribute equity, right? So we need to bring on a new person, and I'm thinking about what kind of equity can I give them rather than give them cash. I'm able to set a value to that equity that I'm giving them, right? So instead of me saying, yeah, you come on, I give you 25%, and I don't know what that 25% is, right? I'm able to actually look there and say, okay, my company is valued at, I'll set a low value. My company is valued at $20,000. If you come and you perform this particular service for me, I'm going to give you 5% of that. And then we can do the calculation of what 5% of that 20,000 is. And then the person can say, okay, I think that's worth my time. That's worth my effort. I may come on.
Going back to that
Right.
conversation we had earlier about wealth, one of the things that I've noticed in my own career is that some groups of people get access to that conversation you just outlined in regard
Yep.
to equity and how does that look. And for many of us, myself included, it's something that you had to kind of interject yourself in or glean from somewhere else, where it wasn't like the first conversation. And so
Yep.
when you think about time and time goes on, our wealth, we're coming from a different starting point with the accumulating wealth. So for those of you who are out there and you're thinking about either joining a business, starting a business, or crafting it, you really want to consider the words that Dave has shared. That there's more than one way for us to grow, even beyond just the business, just the regular business, services and products, that kind of thing.
Yeah. I think that I would say, if I talk to, 10 small businesses, none of those small businesses are going to say that they want a loan. Right. And I'm going to say, what do you want a loan for? And then they're going to come up with a million big ideas on why they need a loan versus figuring out a way for them to capitalize off of their network and use their people that they have that are around them in order to build those same things.
Yeah, I think that that is such an important key thing to think about. Because you're right. I'm running that same thing where someone's like, hey, can you make a business plan for me? And then I ask, well, what's the business about? And it's a good idea generally. It's a grandiose ideal about doing something. And then you say, so what's the skills? What's the team? What's the valuation of what you're trying to do? And they struggle with that. And what's the overall vision? And I think vision has been kind of bastardized a little bit, where vision has gone to from what it should be to this kind of motto. So my motto is that we're dope.
Yep. Yep.
That's not a real particular vision, and that's not
Hmm.
a real vision.
Yeah. So we can go to the next slide.
All right, give me a second here.
So this is this whole thing that I was kind of talking about, right? How is that equity really distributed within a company, right? So we're gonna say I contribute $100 to this company being started to purchase some supplies. I'm not looking for a repayment, right? So that's an important part of equity, especially when we're talking about small companies or when we're talking about actually investing in a company, right? It's not a loan, right? I'm investing in equity because I'm saying that I believe in the future of this company. Therefore, I want a piece of the pie, right? So this company's total valuation of this is $1,000. So if I have a 10% stake in the company and the company has 1,000 shares, I get 1,000 shares, right? So when I get that 1,000 shares, those shares are mine, right? So if we're talking about a small company, a lot of times those 1,000 shares are going to say, like, as the company grows and as the company begins to flourish, at some point in time, I may be able to liquidate those shares in some kind of way. But there's no ready market that's out there for me to liquidate those shares, right? Me liquidating those shares may have to come in the form of me trying to sell back to somebody that's interested in this particular company, right? But we'll get a little bit more into that shortly.
I think it's important to kind of walk people through that again. You did a great job in it, but it's such an important key around how does that look as far as the equity distribution. And so I know I'm asking you to do it again, but I know it's just a key thing that I think a lot of people miss.
Okay. All right. So to put it in maybe a little different words, right? It's really going to be that if you invest within a company, right? So remember we spoke about this valuation piece before, right? So there's a valuation piece where the company is going to be valued at something, right? The valuation of that company, when they decide that they want to have additional investors, can be split, right? So we can split that ownership into all of these different pieces. And these pieces, this is why it's called shares, right? Shares, or, because shares is kind of like a part of ownership, right? If you have one share, you own the company, right? But you don't own the company. You own a part of the company, one share. And that one share is only worth what that one share is, right? So if you have 1,000 shares, that share is worth 1,000th of the value of the company, right? So the more shares that you accumulate within that particular company, the more ownership stake that you have, right? So if instead of having one share, you say you had one share, you decided that you wanted to get another 99 shares. So you had 100 of the 1,000 shares. Now you have 10% of ownership stake in the company versus before you had 1% ownership stake, right? And when we talk about equity distribution, we're going to say that you, as you know, if a company is being set up, who makes these decisions? Who decides who gets the equity? Who gets 10% versus 1% versus 20%? So if I'm a small shop and I'm deciding that I'm going to open up a company and I'm going to incorporate, and I actually do go through the steps of having a board of directors, which a lot of small companies won't do. But I actually go through the steps of having a board of directors. The board of directors would be the people that are supposed to help me make this decision. Who should I really be using? How much should I be really giving to someone for whatever particular services it is that they're offering? Or if I don't have that board of directors, it ends up being me, it ends up being the person who has the majority stake within the company.
Yeah.
So if I have a 100% stake in the company, I can make that decision. If me and Winston, if we have 50-50 stake in the company, I can't just decide like, all right, you know what? I'm gonna go and bring in, this new guy off of the street, and I'm gonna give him 25%. I could give him 25% of my ownership potentially, but the conversation should still happen with my other owners, right? They should still be in the know. But I could sell out to someone. But that's that's opening up a whole nother can of worms that we could discuss in its own separate little call where we start talking about the inner workings of companies and how they have to deal with crazy situations like that.
That is awesome. So thanks for sharing that again. I just think it's such an important factor for people to understand.
All right, so this slide is where we're talking about a public company, right? So everyone thinks about public companies whenever they hear about stocks, right? You don't so much think about, the small mom and pop shop, right? So, or you don't think, that Dell is really not a public company, right? Or that, there are some of these huge conglomerates that are out there that are still owned by the family and they never gone public. Right, but what is a public company? How does this happen? Why do they do this? Right, so in order for you to become a public company, right, you're going to have to go through the process of what's called an IPO, right? So you're doing an initial public offering, right? This initial public offering comes in the form of me issuing some company stock, right? I issued a stock. The process of doing this is not like you don't just do this overnight, right? Because you have to find an exchange that you're going to be able to be listed on. You're going to have to, have all of these bankers and stuff do what we were just talking about, right? Value the company, but it's no longer, me being able to sit at an Excel spreadsheet and be like, okay, yeah, this is what I think that we're worth. This is going to go through the regulators. This is going to go through a lot of red tape in order for you to be able to say, okay, I'm actually issuing this piece of stock, right? Then once I issue the stock, it's going to be on what's called a secondary market, right? So when I initially offer the stock, I issue the stock because I want to raise funds, right? And I want to raise funds so that my company can grow. As I said before, there are really two kinds of ways for a company to be structured and for them to really think about their growth. So either you're going to be issuing debt or you're going to be borrowing, right? So if you're going to be borrowing, you're not going to issue stock. You're going to be thinking about bonds or getting loans from people, blah blah blah. But in this case, we're saying we really want to grow, right?
What's a
Because
downside? So we know the upside, right? Where you get to raise funds from the IPO. What's a reason why? Because there's been obviously some pretty large companies that have resisted going public. What would be a downside of doing that, in your view?
a downside of going public.
Yeah.
One of the downsides of going public is, that you can potentially lose ownership, right? Another downside is going to be that the info there are a lot of reporting requirements, right? So you don't
Quarterly
just go
reports,
from,
like
huh?
quarterly reports and all of that that you gotta.
Yeah, there are quarterly reports, there are annual reports, there are other small filings that you have to make sure that you do, right? Also, a lot of information on the company itself becomes public knowledge, right? And you also can't control ownership, right? You can't say like, all right, I don't want so and so to go and purchase shares of my company. You can't lock someone out of purchasing those particular shares of your company.
So like when people watch these TV shows like Billions or Successions, and there's these hostile takeovers where somebody goes in and says, "We're going to buy up X amount of block of shares, so we own the company." That's kind of what you're talking about.
Yeah. So yeah, you're subject to potential situations like that. You're also subject to situations where you have certain people that will come into your company and they may want to just control you with not having a majority stake, but having a small stake, right? So they're what we call advocates that will be like, all right, this is what we think you should do. And you're also subject to your shareholders, right? So if you were like, let's say for instance, you created a company and your vision was that you wanted to help save the world, right? And you said, all right, I want to go public. When you go public, you're going to want to help save the world, but the shareholders are going to want to help, grow their pockets.
That's right.
So you may have to manage that vision of helping to save the world with, helping those shareholders to grow their pockets, right? But some other important things that you want to know is that when you do go public, right? That's that share price that's set at the IPO. So I think that one of the important things that we want to know here is that a lot of times people get excited when they hear that there's going to be an initial public offering. Oh yeah, did you hear what that stock did when it went, public? It went from, $10 to $80 in that one day. What happens when a company does that? That means that if you issue a stock at $10 and on that same day it goes to $80, that means that that company just lost out on $70 a share. Get it? Because the company only gets the $10 from the initial public offering.
That's
That's all they get,
right.
right? So if the company goes zoom and rockets as soon as it has the IPO, that means that the underwriters and all of these people that did all this work to value the company,
They priced it
they
wrong.
dropped the ball.
Yeah, they priced it wrong, right?
They
Yeah.
priced it wrong.
Wow.
The market is saying something different. So this is also one of those things where we go and we start talking about the market and the market efficiencies, right? So
And then
when we look at the
usually
stock
there's a
market,
reaction in that scenario too, right? So if it goes from 10 to 80, usually it doesn't hold at 80, right? Because there's some reaction to that number.
a lot of times it doesn't. A lot of times it goes 10 to 80 and then it may retreat back to 40, right? But even if it retreats back to 40, there was still this $30
It was missing.
that was lost, right?
Yeah.
So and as what you were saying, right? This is the whole what I was getting into was like the whole idea of market efficiencies, right? So the reason why the stock market exists and the reason why the stock market is what it is today is because we hope that all information is being priced into the price of a particular public company, right? So the price of Ford isn't the price of Ford just because it's the price of Ford. It's because all of this information is always being shared amongst all of the investors, and all of the investors are able to come and say, like, okay, that looks like a good price. This is a price that I'm willing to purchase it at. I don't think that this price is the right price. I think this company is about to fall. I need to sell and get out of this, right?
And then there's
So
a
the
level of excitement that happens, right? So, for example,
hmm,
then there's a certain level of excitement that happens with certain announcements that occur, right? So, whether it's Tesla
yep.
or like the other day, I got excited when I saw this video for this new Hummer EV. I tell you,
Mhm.
I nearly fell out of my chair. And then in the back of my mind, I'm saying to myself, I can't afford that. But at the same time, I was like, this is like the most awesome thing there. And then I looked at my little small GM amounts, which GM has, is a pretty affordable stock. And it reacted pretty positively to that.
Yeah. So when there's positive information, it reacts positively. Negative information, it reacts negatively. In today's market, it just reacts, right? We don't know why it's reacting, So it's one of those things where the economists would say these are still just the forces of the market, right? But then to complicate matters is that now there's so much technology that it's not even always that trades are happening based on the information of the company itself. A lot of trades are being made based on the trend lines of companies, right? So what has that company actually done in the market for this particular second, right? Some smart guys out there creating an algorithm to say we can trade really fast on movements of the market. And there are a lot of people that you'll find online that are creating all of these, this is the way that you invest, follow my way of investing, and you're going to become a millionaire. And I don't really believe in it. I got a finance degree, blah blah blah. So understanding the market says, like, if you come up with something like that, more than likely there are going to be some really bad days that are going to make you say, like, dad, I wish I never would have tried this strategy. But maybe they do work. I don't know, but I wouldn't put my money in them.
Yeah, I think in some subsequent conversations for those of us who joined the WD Consulting channel, I think we can really talk about how people can think about things like ETF, which are like combinations of different stocks and companies that are out there. Because I know that's something you and I talk about a lot, and that really help them to mitigate and to grow. Because in this time, we're talking to everyone here today, a few weeks before the election of 2020. The stock market is obviously doing well, but is doing well kind of despite everything else that's going on. And at some point, we can really talk about how the forces, because quite frankly, I think our monetary policy people are doing a good job as far as managing that and handling that kind of thing. I wanted to move to what you've got here in regards to the characteristics, because I think this is pretty awesome. So, characteristics of a public stock you've got here.
Right? Yeah. So characteristics of public stock, right? They're bought and they're sold on a stock exchange, right? So that's that secondary market that I was talking about, right? So when you go and buy stock, generally you're just buying stock from someone else, right? It's like the secondary market of buying a car, right? You go and buy a used car. The difference is that used car doesn't really increase in value, right? When you're buying stock on the secondary market, generally you're hoping that the company is going to be doing better and that they will rise, right? When you buy that share and you have this ownership in the company, it gives you certain things, right? It gives you not just ownership in the company and a chance to participate in the growth of the company, and the appreciation of value of the company, but you also get voting rights, right? And these voting rights are going to allow for you to annually be able to participate in the board meeting that happens, right? The annual board meeting that happens, and you'll be able to send in a proxy statement, or you'll be able to attend yourself in non-COVID days. And you'll be able to vote and say, like, okay, I think this person should be on the board or this person shouldn't. Now, of course, with proxy voting, it's a democracy thing. So if you have one share, your vote counts as one share, right? If you have a million shares of a company that has, 100 million shares, your vote still only counts as a million shares of those 100 million shares. So you have a greater impact with all of your votes,
Yeah,
right?
I don't want to make this impression like I got a bunch of stocks all over the place. But I do think that's fascinating when you see those proxies and those votes that come in. The one thing I do like and love about stocks, and maybe this is me and you, and hopefully other people who are getting to this will feel the same way, is I love earnings reports. I love listening to the
Yep.
calls. I love the questions from the institutional investors that exist out there. I love that because to me, it not only just to back to you, I think your point you made earlier, it not just tells me what's happening now, but it tells me like what's the future, like what's the plans for the future, or what's their thoughts, especially in COVID days, right? There's you got to
Yep.
react. You got to be very dynamic and react a certain way in COVID days. You just can't be doing things like you did in 2018. It just don't work that way.
Yep. So, because of better technology, there was a day where whenever you owned a stock, you wouldn't just receive a proxy, but you would receive an entire annual report delivered to your house, delivered to your physical address. And annual reports generally are, we could say, on the small size, it would be 90 pages. On the big side, could be like 400, 500 pages, right? But all of these pages are really speaking about what is the company, right? What's their mission? What have they really done in the last year? What do they plan on doing in the next year? Why did they do good? Why did they do bad? Right? And this is management really pleading with all of with all of their owners to say what happened. Now, these annual reports are still available, and you can find them on any company's public website, right?
Yeah,
So if you're a public company, you are required by law to have your annual report available on your website, right? Some important parts of that annual report that you may want to focus on will be the management discussion, right?
I love
And the
that part.
description of the business,
That's the best
right?
part to me. Just what are their view on things? Yeah,
Yeah. And, because you'll find that you may agree with management or you may disagree with management. And sometimes that can be a driver on to whether or not if you think you should continue to invest in a company or if you shouldn't. You know, the ex CEO of Ford, I thought that he had the greatest forward thinking vision when he thought that Ford should not be in the business of selling cars anymore and that they should be in the business of creating a ride share environment where folks would buy into this whole idea that we're purchasing a piece of Ford and I can just go and pick up a car and drive it and then just drop it off at any location and other Ford people would be able to pick up and drive it, right? It was like a crazy, amazing thought, right? That could have really just changed the world. And then they got rid of him.
I get
And
so
then we saw
excited
there.
about leaders that are like that. So maybe it's part of the things that we do here at WD Consulting Groups is that we obviously talk about financing, but we also talk about leadership development. So when you're looking at those kind of organizations, to me, before I decide to buy something, I really think about the leadership.
Yep.
I really think about the future. I just don't say, well, they're moving up or down or it's some cool thing that I'd like to get involved in. I was like, no, who is in charge?
Yep. And what do they think?
That's right.
What, right? Because they could have the smartest guy in charge, but if he's thinking something that just doesn't seem like it makes sense for the company, But let's move forward, right? So the other part is going to be that the board can decide to issue a dividend, right? This dividend, you've probably heard of it. If you play Monopoly, you get dividends, right? These dividends are basically a portion of the earnings, right? So the companies had a great year. They decided they want to issue a dividend. And generally, they don't just decide that one year, right? A company won't just say, all right, we're going to issue dividends this year and we're never going to issue dividends again. There is a such thing as a special dividend that sometimes they may do that's done like on a one-time basis. But generally, if we're talking about a dividend, the company is saying we're healthy. We may be a little bit past like our super growth phase, and we want to instill some type of dividend, right? And this is us giving money back to our shareholders, right? When I give this money back to your shareholders, is it like there's no effect on the stock? Yes, there is, right? So the stock goes down exactly by that dividend amount, right? So if it's a 2% dividend, the stock will go down by 2% the next day. But no one ever complains about that because you can just reinvest it right back into the company, right? Or you can take the money and it can be like your little cash that sits on the side that you use to invest in other things, or that you use to go and buy like, I don't know, some candy or something from Amazon or
You've got a good and if you've got good advice, you could use that dividend to grow your own portfolio in a good way.
exactly. And then the last part, which is the most important part of investing in a public company, is that you have limited equity. I mean, the limited liability, right? And that limited liability is really saying the only thing that you can lose is whatever you invested in the company, right? You don't have to worry about, someone slipping and falling at the company and someone saying they're going to sue the company for $10 million and them coming after your assets. It's never going to happen. If you own your own company, you may have to worry about that, right? But that's never going to happen to you in a situation where you're just investing in public stock, right? The company itself is its own entity, and you just own a little part of that entity that exists, right?
That's awesome.
So, so more about dividends. As I said, where does it come from, right? So, a company every year is going to make or lose money, right? So when they go and they look at their net income line, if they have made money, right? So their revenue minus expenses and taxes and all of that other stuff actually contributes to them making money, they have a decision to make. What do we want to do with the money that we made, right? There's a thing that's called retained earnings, and then there's dividends, right? Retained earnings means that the company is going to keep that money and goes into their cash bucket, right? And when it goes into that cash bucket, as what me and Winston were talking about, like earlier or like in the beginning, they have to make a decision. What do they do with this cash, right? Do they sit on the cash? Do they invest it in, property? Do they invest it in property? Do they invest it in uh, new new machinery? Do they invest it in acquiring another business, new employees, etc., etc.? It goes on in advertising, whatever they're going to decide to do with that cash that's in the retained earnings bucket. But the dividends bucket is going to be what they're going to pay back to shareholders. Now, generally, if I instill, and I was leading to this before, generally, if a company instills a dividend, they don't want to back down from that dividend, right? So if I say I'm going to pay 5 cent quarterly, because dividends are generally paid out quarterly. I'm going to pay out 5 cent quarterly for the next, we're going to do a 5 cent quarterly dividend. I don't want to come, 5 years from now and be like, all right, we got to get rid of that 5 cent dividend. The reason why I don't want to do that is because I'm signaling to the market. I'm telling the market that we can't afford to pay our shareholders, right? And if I'm signaling to the market that we can't afford to pay our shareholders, we're going to have negative negative
reaction.
outcomes from that.
Yeah, there's gonna be negative reaction to that, right?
Yep.
Yeah. Well,
So when we look at the public company stock price, right? As I said earlier, right? The market is what's going to determine that value of the company, right? It's going to be based off of all the information that's available, right? We said before, public companies, they have to report their information quarterly, right? So they're reporting performance, they're reporting anything that's happened, negative, positive, etc., right? Public company is going to have all of the media and online social media. Anything that happens with that company is going to be priced into that stock, right? So if the CEO of a company goes and decides to write like some racist rant on Facebook, the company is going to be penalized for that, right? And we don't want the
yeah,
company to be penalized
we're
for that,
seeing a
but
lot of
it
that these days.
happens.
Yeah, we see that a lot these days, or more than we used to. When you think about those people who are involved in these situations where they're doing something they're not supposed to, whether it's
Yep.
social media or they're involved in some kind of harassment situation, all of those things have a real effect, especially in those companies where the CEO is like has such a an effect on the leadership of the company. When you think about
Yeah.
some of these kind of companies where when that CEO is gone, the company's not the same because they have such a presence.
Yeah. If Elon Musk was to do something crazy right now, Tesla would be like destroyed, right? Because Elon Musk is
He's Tesla.
probably just as well known as Tesla is,
Yeah,
right? So
yeah, he is
so
Tesla.
that's
Yeah, and
yeah, he's Tesla. So
we don't have a sense
that's
of succession planning like Steve Jobs. I think did a pretty good job years ago, no pun intended, where you started to see Tim Cook even before Tim Cook became the CEO. But
yep.
I don't think you see that same thing with Tesla and some other companies.
No, not yet. Right. So then the other place where they're going to get information from is going to be analysts, right? So analysts are going to be providing tons of information. So every investment bank that's out there, every regular bank that's out there, they're going to have analysts that are sitting there, and their core their core job is to really look into companies and see if the company is doing what they say they're going to be doing. Can they achieve what they're saying that they can do? Is the company really viable, right? Does it make sense, right? And then you're going to have industry reports and things that come from specialists, right? So industry reports sometimes are coming from consulting firms that are out there. They're coming from industry publications that are out there. Sometimes they're even coming from, the academia, right? So there are colleges that are out there and they just do research, right? And they do research in the companies and they're saying like, okay, this is where the industry should be. This is how the industry should move, right? And sometimes they do specific focuses on companies themselves. When all of this information is made public, it gets priced right into the price. This is the reason why if you get a tip from somebody that works at a public company and they have information that the rest of the public doesn't have, you go to jail for it, right? You go to jail for it because right now you know something that the rest of the world doesn't know and you can profit off of it, right? So Martha Stewart had to spend time in jail for insider trading and she was worth so much money. And the trade that she got in trouble for was worth something that might be important to me, but definitely wasn't important to her, right?
It's so interesting because you think about, we're a week or so away from an election, and there have been so many Congress people who knew about the the deadliness of the virus back in January and February.
Mm-hmm.
And then there was a lot of information shared that some of them dumped stocks. So whether it was in casino stocks or hospitality stocks, and then they bought a bunch of vaccine makers before they even knew how deadly it was. And then they get on TV and say, this virus is not a thing. And
Mm-hmm.
um, I, I know there's not a, I haven't heard of any specific ramifications for these people for doing it, but there should be
There
because
should be.
that was tough, and they made in every case I heard of, those people made millions and millions of dollars, and they obviously hurt some of those other companies, those casinos, those hospitality people.
I mean, this is one of those things like where you get into the whole idea of white collar crime versus regular crime, right? And you say that these companies that do, or these people that do these nefarious acts, a lot of times aren't penalized for the amount of pain that they've caused, right? When we go back to the .com boom or .com crash, which was more important, right? And you saw companies like Enron and MCI, and you saw how horrible the actions of their CEOs were, where it was important that regulations were put in to say, like, okay, we need to watch what the management of these companies are doing greater, right? Then we get situations where some folks are like, regulation, that's just not good. We don't need regulation. Get rid of regulation. But without regulation, how can we police those people, right? So it's kind of like they're the people. A lot of times, the problem is that this comes from people that are in power, right? So people that are in power are like, yeah, don't watch us. We don't want to be watched. So it'd be similar to the crack dealer being able to say, like, you know what? I actually have power to say, like, yo, we need to decriminalize crack, right? They don't have that power, so they can't do that. But we see on the other side that these people that do have the power, and that's why you get movements like Occupy Wall Street, and it's a groundswell, and people are like not even really understanding what Occupy Wall Street stands for.
Yeah.
Or better yet, maybe understanding what Occupy Wall Street stands for, but the mission of Occupy Wall Street not so much being germane to what Wall Street is supposed to be and what most of the people that are out there doing actions in Wall Street stand for.
I know it was. You're right. It was a lot of feeling and energy, but deep understanding was probably lacking. So
Yep.
I think there's one piece we wanted to share here. I wanted to thank you real quick about you spending time with this audience here today. I hope people who are listening to this now and in the future just really, really take hold of this great stuff that you've shared.
Right. So at the end of the day, the company value, right? So we spoke about valuation, right? We spoke about distribution of stocks, right? But at the end of the day, the thing you want to drive home is that the company value itself is equal to the amount of shares outstanding times the share price, right? End of the day, whether we're talking about a public company or we're talking about, a private company. If you own your mom and pop store and you have shares and you've priced your shares and you have a certain amount that's outstanding, that's the value, right? And that's the same thing that we're going to have. And that's the same thing that we can think about with a public company. So when someone asks you how much is Apple worth, and you hear that Apple is worth, over $1 trillion, which means that it's worth more than probably, I want to say, half of the company, half of the countries, more, even more than half of the countries. It's worth more. I don't have the exact statistics, but I can say that it's worth more than most of the countries that exist in the world. A
There's no,
company.
there's no doubt about that. When you think about just between Apple and Facebook and Amazon, the three of them themselves are, if you had to put their revenue and their valuations against the world, they would be bigger than a lot of nations. There's no
I
doubt.
mean, bigger than a lot of nations. I'm gonna say like they're gonna be, in like you put all three of them together, they're gonna be like in the top 20.
That's right. They're gonna, you think, just on our own, and if you took California as an example out of the United States, right, it would be the fifth largest economy in the world. If you
Yep.
took black people, African Americans, out of the United States, and we all say we lived in another place, we'd be the eighth largest economy on the planet Earth. I mean, so there's definitely some real key things there to think about. This has been awesome, man. I tell you, you've obviously kicked us off in a phenomenal way. For those of you who are listening, this is part one of some great conversations about how we can help you kind of drive your wealth and think about what your wealth should look like. I think we got some great conversations that could happen in the future, specifically around some specific things around how does buybacks affect stock prices, how does ETFs affect stocks, and that kind of thing. And then really linking that, and I know we talked about that here a bit today, but really linking that back to leadership. One of the pillars of what we do here at the WD Consulting Group is around leadership development and understanding that leadership and intelligence are like the two key things that we know that's going to help you become successful in any business endeavor that you're involved in. So it's been phenomenal to have you, Dave. I really want you to leave with any parting words for people out there who are saying to themselves, all right, what I understand, I had a great conversation. So what's my first step? What's my next step? What is something you would share with that person?
All right. So when I was in college, a professor would say, if you want to know finance, read the Wall Street Journal. Right. Today, you don't have to like spend 100 something dollars a week or a month on a subscription for you to read the Wall Street Journal. You can simply go and start reading on companies, right? You can read on everything is available to you. It's right at your fingertips, right? Yahoo Finance, Google Finance. Go to the particular company's websites and look at them, and then use a Robinhood or whatever investment platform it is that you want to use. Robinhood is an easy starter, right? If you have money available on the cash app that's just been sitting there for nothing, you can buy a stock with that, right? Buy something that you care about, right?
That's right.
Buy
Yeah.
something that you think is going to appreciate in value, right? And you'll know to buy small parts of stocks. You'll become a little more interested, and you may start buying more, right? Now, I would never advise for you to start buying stocks if you can't pay your rent, right? I want to advise for you to start buying stocks if you can't feed yourself or the lights are off, right? That's not a wise time for you to start getting in the market. When you do get in the market is when you have some level of stability, right? But you also want to be able to budget for it, right? So if budgeting for it says, instead of you eating out, 3 nights a week, you eat out one night a week, and then at the end of the month, you'll have an extra $100 saved up, and you can put that $100 towards purchasing a stock. That's what you do, right? It always doesn't take rocket science, right? A lot of times people say, I can't invest, I can't find money to do this, blah, blah. The reason why you can't find money to do things is because you're not necessarily budgeting your money correctly.
Yeah.
You can find that people that have very meager means, right? So you may be living from check to check, but if you're living from check to check, my question always is have you really looked at how you're spending your money, and have you made sure that you're spending it the best way possible?
That's right.
Because if
You
you
know.
are,
Yeah.
you'll find some ways for you to be able to save some, invest some, and then you'll also be able to enjoy life.
Yeah. I always I've heard this before, and thank you for that. Is around giving and giving and serving and that what I mean by that is that some part of that money should be around giving to something.
Hmm.
And the philosophy you shared about really understanding what's that right amount. If you go out and get something to eat, don't if you do that less, you probably can save $50 per, even if it's just you and another person. And then what you'll find is that your own personal capacity and your knowledge about these things continues to grow. And one of the things you said that was so powerful that every single person, and it really chaps my butt when I hear this, is when people say, "Well, I just gotta, I'm investing in stuff just so I can get paid, so I can get paid." You gotta invest in stuff that you have a feeling for, that has some resonance with you. If you love Apple phones, you should maybe invest in Apple. If you love cars, you should invest in the auto industry. Whatever it is, if you love medical stuff, you should invest in medical stuff. You should really link it to who you are on that level, because then you'll find yourself more connected to it at some point. Um, this has been great, Dave. It's been phenomenal. Everyone who's out there, WD Consulting Group, I put up here a tricky little thing that you can copy and paste if you can. There's also really a way to get more information from us. If you copy and paste that, and we'll obviously put that down as an active link inside of the show notes, where you'll be able to go in and say, all right, I want to talk to these guys more. I want to learn more about how they can help me or we can help you or vice versa. Please feel free to do so because we want to be able to do that with you. This is going to be a great series, Dave. Thank you so much for doing this. Um, I appreciate you so much for joining this. And for those of you who are out there, thank you for joining as well. And continue to watch out and check out our channel for more phenomenal conversations. Thank you, brother.
Later.